growth requires more than capital.
Why do we call it the cheat code? Nobody said growth had to be fair.
Revenue solves everything.
Welcome to the cheat code. What was our fastest path to revenue?
We tend to like to do things the hard way.
What's the cheat code? It's giving yourself an unfair advantage over the others.
What is it that really works, and how are we going to grow these organizations?
That's our cheat code.
All right. Well, guys, we're back on an impromptu edition of the cheat code. I'm, of course, joined by Mr. Joshua Wagner and Sean Kester, who may or may not be a frozen screenshot for some of this because he's in a snowball situation up there. But we wanted to kind of gather and respond to some of the conversations that are happening. I know, like, we've all been a part of a lot of threads going on about, what's going on at OpenView Partners, and then just what's going on, people expounding their thoughts on what the future of VC holds in general. So good forum just to kind of hop in and probably share some of our thoughts and get you some of you guys' takes on the situation as well. So to kick us off, I guess, Josh, I saw you put up a post this morning. So obviously you've had a chance to kind of dive into things a little bit. Like I guess let's just start with like a baseline of what you've taken from the situation and kind of what you've learned, and we kind of dive in from there.
Yeah, I it comes back to the stark environment that was 21 to today for the venture world. I think there's not more contrast in many things than you see there. When valuations were at an all-time high, the way you won deals was just by giving founders more money. And it created this crazy environment and just this bubble. And we've seen a lot of the data that shows that 2021 valuations are an extreme outlier, even from a normal graduation curve of valuations on a regular basis. And now you come into 2023, valuations are coming down. And I think as a result of that, the way founders are accepting these lower valuations is by saying, well, what other value are you bringing to me as an investor? And that value add investing seems to be a really common theme, especially as we talk to folks, right? Like, I really like what you guys are saying around go to market. That's where we need help. We need someone who is not just giving us a bunch of theories and is going to jump in with us. They understand what we're going through. And that's what Operator Immersive was intended to be. And for us, we had the benefit of hindsight, right? We saw 2021 in the rear. We weren't investing as a firm at this time. We were able to look at some of those trends and go into it. Now, when I think about a fund the size of OpenView, $580 million, I think, right? That it's hard to deploy that much capital, especially when you think about valuations coming down, right? You're not going to just overvalue someone for the sake of overvaluing someone. And then the expectation of a founder saying, hey, we need you to bring more than just capital to that environment. How do you do that across a portfolio that big with partners who, maybe have already hit the home runs and they don't want to dig in that deep, right? I don't know. It's just a theory. I'm not saying that these guys don't want to work hard, but everything I've read is saying that the partners just kind of don't want to be in the business anymore. And that's, initiating these clauses that say you can't deploy capital without a key man in it and things like that. So those are some of the initial things that I got out of it. Just overall, investing is a bit harder because of the environment and expectations of founders.
Yeah, I think there's some good points there. Like, I also was reading, a post that Scott Almer put up, who I think is just doing a great job at like being a, Johnny on the spot reporter for overall business news. So like great kind of niche that he's started to fill. But, so he put up a 3-point, like, this just doesn't work anymore type of situation. And I think for me, it's like, it's more fundamental, right? Like, if you're looking at what OpenView really focuses on with their Fund 7, and, that is that $570 million, fund that you mentioned, which was just raised earlier this year, that is a scale-focused fund, right? Like, these are organizations that are not seed or early growth type organizations. They're orgs that have found product market fit, and they're ready to kind of, slingshot all systems and to go. I didn't know. And I don't know if he put up, I have to pull up that article, but I don't know if he put up a source around this, but like he mentioned, like there are 1,200 unicorn organizations waiting for an exit right now, like, and most likely an IPO, and that only 200 software organizations have gone public within the last 10 years. And there's, we should probably pull up and put in the link in the description here, like the chart that shows the years of that, because like no one's going public right now, right? So there's a massive trough that's being created, and largely because the economics and the growth trends within the business have not continued into 2022, 2023, right? Like those, to your point, valuations were up, but performance was also up really from, late 18 through 21, for the most part, despite COVID. Some industries that were really pulled down, but like B2B software was a free for all because everyone was going digital, and we participated in some of that, certainly at LeadMD, where it was like, hey, fix us, doesn't matter what the cost. And so you got kind of this a bunch of different artificial signals and aspects that created growth within the market, and now you've seen that pretty much grind to a halt. And so, if you can't get those ultimate outcomes, a fund like an OpenView that focuses really on that stage with large amounts of money that have to make huge numbers of investments in order to make those economics work, like there is no outcome. There is no pot of gold at the end of that rainbow. So like, I think it probably is even more fundamental than like what you mentioned. I certainly agree with Josh, but I think the model fundamentally, there's something going on there from an economic standpoint that just doesn't work with huge funds. And obviously we all know the reason for raising, large funds. Sean, I'm curious to get your take, because you've been, so far we've had a bunch of bootstrap guys talking, but you've seen this journey as well. I'm curious as to your thoughts on these happenings, from someone who's operated within, an organization that, played the alphabet soup and won type of a situation.
These organizations where the ball is not even encouraged to not be cash efficient. And so they had to take big swings, spend a lot of money on marketing. And that was encouraged, especially in Silicon Valley. And now things have changed, and so they have to be cash efficient. At that point, they're overvaluated, and there really is no exit potential other than being cash flow neutral or positive.
Well, that's a good point, because the other thing that's happened, obviously, in order to kind of straighten out that growth curve, pretty much every organization on the planet has gone through a cost cutting exercise, and for the most part, that is done at this point, right? Like some orgs have rehired some of their folks, but we've reduced headcount, we've reduced OpEx. Now the only way to grow is to actually do so, right? Like either expansion within existing clients or attaching net new logos. And so now you've got that cash efficient mentality, but now you actually have to simulate growth as well, which again, like you're going to see, I think, the really skilled go-to-market teams are going to be the folks that are able to make that work. And largely there's going to be a massive bucket of folks that have been great while it was feast. Now that it's famine, I think you're going to really see some of that performance struggle. And that goes to your point, Josh, which I think is more on the value creation side that we've seen, with folks like Vista and Insight and OpenView that have really kind of championed that model. But you and I also know what that looks like functionally as well, right? And that certainly, in my opinion, does not fulfill the promise of like, hey, we're going to really amplify, fill in the blank, whether it's dev, go to market, operations, whatever happens to be. Like that's really tough to do from a fractional standpoint or from an advisory standpoint. So what do you guys think is the answer around the value creation aspect? Because there are a lot of dynamics pulling against each other there. Number one, this is normally fostered within either the LP base or within an operating team. And to my point there, like it's difficult to do that fractionally without people that have a real dedicated focus. So like, is it just, bite the bullet, shut up and do it? Or, what are the other options there?
Well, I think one of the answers starts with something that you said earlier around so many companies are valued as unicorns, and then the only option is IPO. So you gave Scott a shout out. Let's give David Paul a shout out. I saw a snippet that he posted from his LP dinner the other night that said the data shows that the majority of positive outcomes come in like the 100 to 250 billion,
50 to 100 range.
50 to 100. There you go. 50 to 100 million dollar range. Okay. Well, that's a new expectation, right? When you're thinking about someone with a unicorn expectation with this exit, you're only option is an IPO at that point, right? That 50 to 100 range, there's a lot of options, right? Your pool of outcome, your people that can make that transaction is much, much bigger, right? So it gives you, so that comes all the way back to the stage of where, early seed or seed stage investing. What are the outcomes that we're looking to achieve with this company? Having those honest conversations with the founders at that time to say, what does success look like to you? And being able to bounce that off of an expectation set with an LP base for what does success look like to them. Okay, so if you can have that clear expectation set much earlier, then accelerating go to market, to your point, Justin, now becomes a little bit of a different story, right? You can say, how many people have been burned by, here's your boatload of equity that's just vaporware for some event that's out in the future that we can't really make tangible because it could be an IPO, it could be whatever, overvalued, now we're worth nothing, all this kind of stuff. But what if you're able to go to a go-to-market leader with some real chops and say, this is the outcome we're looking for. We know where to find that outcome. It's going to take us 2.5 years because we've got these players in place. This is what we need to sprint towards. And we can put you in place to do that.
Yeah, I think
that's a different conversation, right?
You have to open up, the optionality. I know we've all talked about like fund dynamics and what a shitty term that is, but like that literally needs to be, one of the fundamental changes here. I think so if we even just go through the list, like you've got to be able to add more value than capital. You've got to be able to create, really flip the success ratio, right? Like the 2 in 10 needs to become an 80-90% success ratio,
right?
Or what are we doing here? You know what I mean? Like if you're willing to trash or have negative outcomes on that large of the investment, I think that's where another economic lever is really getting pulled, which is that investors are really and you're seeing this across the board, institutions as well. Like capital is getting tight. Folks are really looking for vehicles that don't have that big boom pop performance, but like have a decent return, that have a lower risk profile, that is something that's going to happen within their lifetime. A lot of these investors, your boomers and so on, like they're getting to an age where they don't have a horizon for 10, 15 years within their investment any longer. So all those are again starting to add up to where like you've got to be able to provide better optionality both to your investor base as well as your invested, your startup, your founder base, and say like these are acceptable outcomes, which within traditional fund dynamics just would not be. And then the other thing that I mean, like I'd love to get you guys' thoughts on size, or like let's just even like throw it out there in terms of the like, are we going to raise a fund? Are we not going to raise a fund? Like what are you guys' thoughts on funds, the size of those funds, and how it plays into what venture capital looks like going forward?
I think funds sound sexy. I think people like to gloat that they raised a big fund, and I think it's a thing that everyone looks at to a VC and as a kind of a measure for each one and saying how big the fund can they raise. I think it gives you some fiduciary responsibilities that make it really complex and difficult to be able to execute in the way that you probably would and founded that firm in the first place. So your intentions in the first place is to help these companies grow and scale and help the founders achieve their dreams and help them grow businesses and hire people and have those folks also achieve their dreams, right? But then all of a sudden it becomes that goal gets clouded by the fact that you have this fiduciary responsibility to, one, execute on the money. And the more you raise, the more you have to do, which means that you're going to take bigger swings. Things are going to fall through the cracks. You can't manage 10, 15, 20, company portfolio the same way you can have 2 or 3. And you're not looking at each one individually as probably as closely as you should. And I know a lot of these, larger VCs have, one deal they're supposed to do per year, but then they're immediately focused on the next one, right? And so, if you can't just have a fun run forever. So I think it just makes it hard.
Well, before we move off that's a really important point, because I won't mention any names here, but like obviously like our go-to-market strategy is partnering with other capital firms. And I think it's been incredibly eye-opening to look at the gradation of difference between what those, and again, like I'll kind of paint between the lines here, like the larger the firm has been, the less diligence, the less transparency, the less solid, I would say, I found those deals to be versus, and I'm not saying that, that it's on the small side, but like the, mid-size, highly diligent, like I've found those firms that we partnered with just to be incredibly responsible in terms of how they are investing their LP's capital, pragmatic in terms of the opportunities that they're looking at, and it's transparent and straightforward about the optionality for exit versus what I would call like, a lot of, to Sean, to your point, like the size of the fund has really become the pedigree within VC, and we partnered with folks that have very large funds as well. And I've not found that to be the case on that side. And also, if you look at what's happening in some of those partners, they've done a rapid number of investments as of late as well. And that just to me says, like, I don't know how you can manage 6 or 7 simultaneous investments and provide the value that we've been talking about providing here. In fact, I think that's an indicator that it is simply a capital offering.
Yeah, you make that big fund, you make all those investments. In order to service those investments, you frankly need more manpower, right? So now all these fees that you're collecting, you're just creating operational expense within your business now, right? And listen, fees are a part of the game. I mean, you have to have them to operate the business, but not to get too deep on it, but like, the fees we collect on a deal by deal basis, we're not making a living off of those as individuals, right? Like we are using those to operate the business and really put our focus and attention into the founders and their companies so that we can all get a good outcome. And that's where we expect to make a living, right? We're not expecting to make a living off fees. You have a $570 million fund. There's some pretty hefty fees there that those people are probably making a living off, and you're hiring other people. It's somewhat inefficient for your LPs and then, your founder as well.
And that's a good point. You know what I mean? Like obviously most funds reserve, a portion of those that individual fund for follow-on and pro rata and so on. But when you start to take a 3-year break in terms of business growth, that again fucks up those economics, right?
Correct.
Like, so even if you've got large fees and you were counting on exiting, your 2 unicorns, in 23, 24, that's most likely not going to happen. And so now all of that just gets snowballed down the road. And again, I think if you look at the reason that, and not a lot has been put out about this OpenView thing whatsoever. There's been far more commentary on and kind of amusing remarks on LinkedIn around it. But like, obviously, they lost some critical partners who stepped out of the business. They've recently raised a fund, which created a lot of pressure to perform. There's all the conditions that we've, kind of talked about ad nauseum here. And that just didn't add up to something where they felt like they could perform. Now, kudos to their point. They did this very rapidly and gave money back very rapidly, because the same thing we're talking about here, like immediately when you start carrying those cap calls, you're eating fees out of them. Like I would assume their number one goal was to make their LPs whole, or absolutely as near to it as possible. And so normally I think that's the reason, like no one knew this was coming, because the minute that they decided it made sense to simply, peel it back and unwind it. The interesting, so again, I won't name any names, but, like largely the narrative has been, frankly, what we've been saying out there, like, hey, I think this vault's broken, because fucking it is broken, right? Like I've seen some other folks chime in and be like, oh, there's all this negative stuff happening for OpenView, and those are great guys, and I love their content. Yes, absolutely. Like, I don't want to skip over that. Like, these guys created what I would call like that operating, or help create that operating partner model, and great research, great content.
Yep.
Like, I've been interviewed, I've done talks at an OpenView event before. Excellent stuff. But at the end of the day, $570 million that you've got to deploy on scaling growth stage companies, latter growth stage companies, doesn't add up. And so like the markets equalize, like it just, things go in the direction that they should go in. I think I'd be much more apt to say like, hey, don't, what they call it, punch down on this model, rather than raising one of those, the most recent fund, they would have said, hey, we're going to change something fundamental about our business model. But frankly, I think they were kind of rinsing and repeating at that point. And again, I think you saw some partners kind of understand that and step out because of it. But my entire point there is like, we have to call a spade in relation to what's happening here. I don't think it's the last time we're going to see this happen. And I think it's a big, just kind of early warning for different structures like SPV, which obviously we like quite a bit, because it's getting more competitive out there for LP dollar. And the same struggles that are going into startups are only compounded within this financial environment. Like we see that every day as well. So that's my diatribe on, like, let's be honest about this and not kind of gloss over it.
Yeah, I mean, if high net worth individuals are tightening, institutions are doing the same, right? Like institutions are largely investing on behalf of another group of individuals, right? So now it's a derivative of people.
I mean, like, institutions aren't investing from a traditional lending standpoint right now. Just as an anecdote, so we're recapping a business right now, and we took that out to 65 lenders to get one term sheet. Literally took 7-8 months to make this happen. Now, it's a $50 million recap, so like it's nothing to shake a stick at, but like it's getting tight out there. And to your point, like I'm seeing a lot of, if you look at what's going on from an economic standpoint, a lot of the inflationary prices that have come down have done so in your larger purchases, appliances, cars, homes, obviously because of interest rates and so on. And I think you've got that last little piece, which is like largely like food and consumer goods and things like that, that's going to pop, and we're going to be in a really tight scenario. So again, like something has to fundamentally change here, and that's where the good will come from. I truly believe that.
Yeah, I mean, it always comes back to, OpenView is a big behemoth, right? We'll just call it that. Like, when you're in business, the small guy's advantage is always being nimble and being able to pivot quicker, right? So, that's kind of what we're leaning on right now, creating a competitive advantage, being small, being nimble, being pragmatic, versus, as you get bigger, those things, it's like turning the Titanic. So it's kind of where we are, and it's just a market dynamic, and hopefully we can come out on the right side of it.
Sean, parting thoughts, frozen thoughts?
Let it go. Let it go.
All right, guys. Well, thanks for hopping on. I know this has kind of been impromptu, but hopefully this was valuable out there. Thanks again for joining us. If you're joining us for the first time, please subscribe, like, visit inrevenue.capital, get on our newsletter list. We put out a ton of content, and of course a weekly podcast here at The Cheat Code. Thank you so much for joining us. For myself and my co-hosts, Sean, Josh, enjoy. We'll talk soon.